Hi, this is Ernie. I'm the guy who had $6 in his checking account to now having millions of dollars. As promised, I'm creating a course, 13 video course for those who are willing and interested in learning about options. And I already created a video yesterday, and this is going to be my video number 2. We already talked about what options are and what call options are and what put options are at a very high level. Today, we're going to do a deeper dive into what call options are. There are 2 ways to make money. One is selling calls, which is what I do very often. The other one is buying calls, which is something I don't do. So let's go with what buying call means. The simplest description that I can give you about buying calls is buying a lottery ticket. The probability is better than buying up a lottery ticket, but ultimately that's what it is, because you're spending very little money to buy a premium, and I'm going to explain with a chart, hoping that my stock is going to take off. And if it does not take off, I'm going to lose pretty much everything. But if it does take off, you might make a boatload of money. You might make, 2x, 3x, or in some cases like 40, 50, 100x. And that's why a lot of people who buy options, and of course, it's not just like randomly buying them. You have to have some type of a thesis or hypothesis that says, oh, because of these, I think the stock could potentially take off. Or sometimes you're just lucky. But even then, you will hear news like earning was great, profit was great, guidance was great, and then stock falls. And that was the case with, for example, Nike. So I lost all my money when I bought Nike calls. So even if you made the bet correctly with the right hypotheses, sometimes like there's war, or sometimes, Federal Reserve says something and then market tanks and it brings everything down. So you end up losing money. And what is the probability that you will lose money? Oh, way better than lottery. Lottery jackpot for Mega Millions or Powerball is like 1 out of 800 or 400 million. This one is you will win about 10% of the times, but 90% of the times you lose money. That is the current statistics on those who are buying call options. So let's use a real example so that you can see how it works. So I'm going to use MSTU that's trading at $5.05, or that's what it closed on Friday. And to look at some of these charts that's fancier and nicer, I got to use Thinkorswim from Charles Schwab. So what you're going to see is I'm going to make a bet that it's going to go above 550. And you need to come up with the reasons why you think that way. So then what you're going to do is you're going to pay 24 cents or 26 cents in order to buy one contract per share. So if you buy one contract, you need to multiply that by 100. So you would actually have to spend $26 plus commission. And this is the profit chart. What it means is because you pay 26 cents for you to break even, right? Recoup all your money and break even, by this Friday, you not only have to win that or make it correct that it's going to go up, you have to also guess correctly that it's going to go up by more than 26 cents above 550 when it's already trading at 505. So the price has to go up by like 10% or maybe even 11, 12%. So once the price goes up to the 550 plus the premium you paid, amount of upside could go to infinite amount of money that you can earn. But if you don't, if the guess is not correct, then you're going to lose everything. Do people know this? Of course they do. But why do people keep buying call options? Because of this. That's one of my wins. Many, I need to take my glasses off to read. Many, like 3 years ago, 4 years ago, I was able to turn $6,000 into $173,000. Does this happen often? No, maybe once every couple years. This, because of this addiction, once you win something big and you want to repeat the same thing, this is why people buy. And there are people who correctly guess and make money, but this is very, very few in the marketplace. Even with my best guesses using all the tools out there, I think I win maybe 1 out of 8. Not even, it's not even 1 out of 4. That's greatly better than, 1 out or 10%. I still lose money. So based on statistics, I realized, you know what? I'm just not going to waste money on this because not every win is going to look like this. And when I do make calls or buy calls, knowing that there's a good chance that I'm going to lose money, what do? I use the house money. And that is the key so that you're not losing your initial investment or hard-earned savings by betting completely wrong against the market. Now let's talk about selling options. And I'll talk about the risks and rewards. So I'll go to the whiteboard so that I'll be able to explain to you one by one. So using the real example, let's say it's trading at 505. So on Monday, I saw the cover call at 550 and I get premium of 24 cents. So if I have, let's say 10 contracts or 1,000 shares, that's about $240 or 5% a week, which is amazing, which is more than what you could typically get. But you get a lot of premium because it's a leveraged fund as well. And what happens? What is the risk? And I'll explain the risk as I'm going through 2 scenarios. Let's say on Friday, so I saw the call at 550 expiring this coming Friday, but let's say the price did not go to 550. Let's say it went to 540. Then what happens? I keep the shares because it never got exercised. So whoever bought my options, it's actually better for them to let it expire and buy shares at 450 rather than pay 550, right? So I get to keep my shares. I still keep the profit. Options expire. And what do? I rinse and repeat. I repeat the same thing. But since it's trading at 540, most likely on Monday, I'm going to try to sell it at $6. So you're keep able to use that premium to buy more or take money out or however you want to use it. So this is the best possible scenario. Actually, I don't think it's the best possible scenario, but a lot of people think this is what is the best outcome for them because they just got free money. I would actually prefer when it's 551 so that I can sell my shares, make the money, and then buy it back pretty much at the same price. But anyway, let's go to scenario 2. Let's say it goes up to $7 and you are thinking to yourself, shoot, I should have never sold it, right? Because if you didn't, you would capture a lot more money because it's now trading at 7 rather than 550. But in this case, what happens? You still keep the profit. Now you are obligated to sell it at 550, but I bought it at 450. So you capture a profit of $1 per share. Remember, I bought 1,000 shares, so that's $1,000 profit plus additional $240. My shares are gone. That does not mean I cannot go back in. I could just go back in and repeat the same thing. What happened to options? Somebody exercised. And repeat on Monday, meaning I go buy the same shares at $7, and of course it's more expensive, and repeat the same thing, assuming that this is still relatively cheap in valuation and it has more room to go. And of course, this drops to 5, then you're not going to be able to repeat the same thing. So the risk of this is that you are capping your upside by selling cover call. But to be honest, I don't know what's going to happen tomorrow or 30 minutes from now. I want the guaranteed money rather than hoping that it will go up. Hope is not a strategy for me. I could have hoped that a lot of these stocks that I bought has skyrocketed. Yeah, it doesn't happen that way. So the choice is you hope and wait and it might never happen, or you do cover call strategy and generate income every single week and use that money to buy or pay your bills. Hopefully this answers your question.